Are we going to get a major market crash in September? That is the question on every crypto investor's mind right now. Over the past decade, September has built a reputation for nuking markets into the ground. In 2013, 2017, and 2021, September delivered sharp corrections that wiped out weeks of gains in a matter of days. And already this year, Bitcoin has started to stumble, Ethereum has pulled back off its high highs, and fresh inflation data is sparking fears that history may be about to repeat. On the surface, the setup looks dangerous. But the signals are mixed this time. A simple cycle strategy that has never failed is telling investors to sell. Yet other metrics hint that the market may still have room to run. Confusion is growing as traders weigh the risk of another historic pullback against the possibility that the best part of the cycle has not even arrived yet. In this video, we'll break down what history says about September, why the signals are pulling in different directions, and how investors can prepare for what comes next. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's start. Every market has its own seasonal patterns. In traditional equities, traders talk about the summer doldrums or the infamous sell in May and go away. In crypto, the equivalent is September, a month that has built a reputation for punishing investors. Across multiple cycles, September has repeatedly delivered sharp pullbacks, wiping out weeks of gains in just days, and in some cases triggering the kind of cascading liquidations that create near panic in the market. To understand the weight of September in crypto history, we have to look back at the last three major bull market cycles: 2013, 2017, and 2021. Each of those years, September brought sudden crashes that fit eerily similar patterns. In 2013, the correction began right on the last day of August, dragging into the second week of September. Bitcoin fell around 15%, which may sound moderate, but for altcoins, it meant losses double or even triple that size. The correction wrapped up in less than 2 weeks, but not before a liquidation cascade wiped out over-leveraged traders. Then came the rebound, and history shows those who stepped in during the flushout were rewarded almost immediately as the bull run resumed. Fast forward to 2017 and the cycle repeated, but with even more intensity. Once again, the drop came early in the month, September 2nd, a Saturday. By mid-September, Bitcoin had dropped nearly 40%. That scale of drawdown was devastating for the altcoin market, with many tokens losing half their value or more in just days. Just like in 2013, the bulk of the carnage happened in 2 or 3 massive red candles, and just like before, it was over quickly. The market shook out weak hands, destroyed leveraged longs, and then bounced back with even greater force in the months that followed. By 2021, seasoned investors were aware of the September curse, but that didn't stop the market from repeating the pattern. This time, Bitcoin rallied in early September, luring in traders with a bullish setup before reversing violently on September 7th. The correction lasted until the 21st and erased about 25% of Bitcoin's value. Once again, altcoins were hit harder, with many plunging 30% to 50%. And just as in the previous cycles, the sell-off clustered into just a few critical days, where 2 or 3 massive red candles defined the entire move. The consistency of this pattern is why traders are on edge in 2025. Every 4 years, September seems to deliver its punishment. The crashes don't drag on for months. Instead, they come suddenly, rip through portfolios, and then give way to renewed rallies. Historically, each of these September pullbacks has lasted about 2 weeks, and they've almost always been followed by strong finishes into Q4. For long-term investors, that's what matters most. The short-term losses are painful, but those who endure them or buy into the fear have historically come out ahead. This year, Bitcoin has already corrected more than 10% in August, driven by hotter-than-expected inflation readings. That's where the worry intensifies. If history is any guide, that may not be the end of the pain. Inflation-linked data like the Producer Price Index and the upcoming PCE release could serve as the triggers for the kind of sharp 2 or 3 day meltdown that defines a September correction. If Bitcoin falls 20%, as it has in past years, the $100,000 level is the key line in the sand. Breaching it could drag altcoins down 30% to 50%, exactly the kind of wipeout we've seen before. So when people talk about red timber, it's not only a catchy phrase, it's the result of a decade-long pattern where September brings fear, forced selling, and violent corrections. And that's where our analysis begins, because while history doesn't repeat perfectly, in crypto it has a tendency to rhyme in ways that can't be ignored. The September curse explains why traders feel uneasy as the month approaches. But beyond seasonal history, there are signals flashing right now that add weight to those concerns. One of the most talked about is the so-called 500-day Bitcoin strategy. It is popular because of its simplicity and its track record. The idea is straightforward. You buy Bitcoin 500 days before the halving event and you sell 500 days after. That keeps you invested for about 1,000 days each cycle. If you had followed it in the past, the results would have been extraordinary. The first cycle delivered nearly 3,000% gains. The next cycle over 3,400%. The one after that close to 1,000%. Even this cycle, the strategy has already produced more than 500%. If someone is strict about following the rule, this is the time to sell. The calendar says the 500 days after the halving are here, and history says that is when you step away. On paper, it looks perfect. You would have locked in life-changing returns every single time. The problem is that markets are not only made of rules, they are shaped by who is participating and what forces are dominant. The market structure today is different from the cycles when miners controlled supply. Back then, miners would hoard coins and then dump them when prices surged, dictating much of the rhythm of the bull run arm. Now, miners are no longer the largest players. Companies, investment firms, and even entire nations are holding Bitcoin for the long haul. To understand why the debate is so heated, we need to look at the technical signals that analysts track. The MVRV score is one of them. It measures how far market price has deviated from the average cost basis on the blockchain. At every previous top, the score has surged above 6.5. At every bottom, it has hovered close to 0. Right now, it is sitting around 2.5. That is nowhere near the overheated levels of past peaks. The investor tool tells a similar story. It uses the 2-year moving average multiplied by 5 to identify extremes. In every prior cycle, the top aligned with price reaching that level. Today, the line sits at more than $360,000. Bitcoin has not come close. Another widely followed measure is the Pi cycle top indicator. It is flagged the exact top in every cycle, including 2013, 2017, and 2021. This year, it is not even close. The gap between the moving averages that form the signal is the widest it has ever been at this stage of the cycle. Historically, that has meant the market is closer to a local low than a global high. The absence of a cycle top signal across all these indicators suggests that selling now may be premature. Still, the logic of the 500-day strategy weighs heavily on those who want to lock in profits. If you sold, you would walk away with a 5 times return in this cycle alone. For many, that is reason enough, but the evidence from chain metrics and from the structure of today's market points to something different. The risk is that selling now could mean missing the very phase of the cycle that historically delivers the largest gains. The transition from seasonal history into technical indicators is important. History warns that September has teeth. Indicators warn that the true top has not yet arrived. Together, they set up a unique tension. Do you protect your capital by following the flawless record of the strategy, or do you lean into the data that says the blow-off top has not yet happened? That is the dilemma facing investors today, and it is the reason September feels heavier than usual. The clash between the September curse and the 500-day rule leaves investors in a difficult spot. On one hand, history suggests a sharp correction could come in the weeks ahead. On the other, none of the indicators that have called previous cycle tops are signaling danger. When faced with that kind of uncertainty, it helps to step back and look at a broader time frame. The question isn't only about surviving September, it is about what usually happens after September passes, and that is where the charts tell another perspective. The quarterly performance chart for Bitcoin reveals one of the most consistent patterns in its history. The fourth quarter of each cycle is overwhelmingly strong. In 2013, 2017, and 2021, Q4 delivered some of the largest returns of the entire cycle. Even after bruising September pullbacks, the market found its footing and then surged into the year's final stretch. The reason is simple. Liquidity typically expands heading into the end of the year. Tax strategies encourage positioning, and in crypto's case, speculative appetite grows as momentum returns. If we narrow the lens to monthly data, the picture becomes even clearer. September ranks at the bottom for Bitcoin and Ethereum, but October, November, and December rank near the top. For Bitcoin, October alone has often been the single best month in the cycle. Ethereum shows an even sharper pattern. When the market enters Q4 with momentum, Ethereum's returns frequently outpace Bitcoin's, pulling in capital from altcoins and consolidating its role as the leader of decentralized finance. The heat maps of monthly returns show deep red in September, then a quick flip to strong green in the final quarter. It is not an accident or one-off. Across multiple cycles, the data is consistent. If you are positioning for the next 3 months, the odds favor a powerful move higher. And it doesn't stop at the end of the year. The first quarter of the new year has also been historically strong. That 6-month window, stretching from October through March, has accounted for some of the most explosive gains in Bitcoin and Ethereum history. Looking at Ethereum specifically, the implications are even greater. Its market capitalization is smaller than Bitcoin's, so capital rotation into Ethereum after a September washout often amplifies returns. In past cycles, Ethereum has turned 20 to 30% Bitcoin rallies into 50 to 100% surges of its own. For traders, that volatility can be brutal, but for investors, it can mean outsized opportunity. The performance charts don't just tell you what has been bad, they show you when the window of strength historically opens. According to the charts, calling September the end of the cycle can be misleading. Yes, it is often the worst month of the year. Yes, the flushouts can feel like Armageddon, but in every cycle, those crashes have set up the strongest runs into the end of the year. If you zoom out, the lesson is not to fear September, but to prepare for what comes after. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.